Welcome to the Thematic Investors Podcast, presented in partnership with Vidrio Financial. Vidrio Financial is proud to support the Thematic Investors Podcast with host Kieran Cavanna. Unlock the potential of precise and dependable investment data with Vidrio Financial's data management solution. We shoulder the responsibility of your data, from its collection to extraction, transformation, and enrichment. With a track record of monitoring over 2,000 diverse funds and processing millions of data points each month, Vidrio leads the discussion on how investors can harness advanced AI and human expertise to maximize alpha performance and enhance their data accuracy. Discover how Vidrio empowers your data with comprehensive analytics on performance, cash flow, risk, and valuation, all delivered seamlessly through Vidrio's Data Management Hub. By consolidating multiple systems into a single source of truth, Vidrio saves your investment teams valuable operational time, providing actionable insights like never before. Explore more at vidrio.com.
Welcome to the Thematic Investors Podcast. I'm your host, Kieran Cavanna of Old Farm Partners. Our goal is to bring you great investors and themes they're working on. Some are under the radar, and we think they're experts in their disciplines. Excited today to talk to Will Homan-Russell of the UK. Welcome, Will.
Hi there. Thanks for having me.
It's my pleasure. So yeah, it's a very interesting strategy. Will runs a hedge fund in London called Albemarle, the Albemarle Shipping Fund. It's focused on the shipping sector. They are a long-short equity fund. They've done exceptionally well since they started. And we're going to learn a lot about shipping today, which is an incredibly interesting sector. I've learned a lot through my due diligence on your fund. So we go in several directions on shipping and how you manage money. But, it'd be great just to kick off as well. Could you give us a sense of, rundown of your career and how you got to this spot, managing money and focusing on the shipping sector?
Yeah, sure. I started in 2003. I'd done a maths degree at Oxford University, and then pretty much out of there, I joined a company here in London called Tufton Oceanic. They were originally a mezzanine lender to the shipping space, and then a financial advisory firm. And then from pretty much when I joined them, 2003, they started setting up, moving into the fund management space with leasing vehicles for funds for owning ships and leasing them out to operators. And then they also set up a hedge fund investing in long short in shipping and the energy space. I joined that company 2003 on the asset side of the business originally. So as a shipping analyst and analyzing the credit worthiness of these potential lessors. And then a couple of years later, joined the other side of the business, running this oceanic hedge fund. So I started there in 2005 or 6 as a shipping analyst, analyzing listed equities, and then started taking over portfolio management role from about 2008-9 onwards, before taking over the whole of that kind of oversight of that shipping book. So that was, at the peak, we had about $1.8 billion under management, but like I say, focused on shipping and energy. It was investing with a fundamental basis globally, mainly in listed equities, but also in some commodity derivatives. I worked there until 2018, when we could see that the fundamentals were improving within the shipping space. I was keen to get more kind of pure exposure to shipping, to remove that energy component, and also to set up my own business. So with 2 other partners, Cato Stonex and Magnus Halverson, we set up the Albemarle Shipping Fund, or the precursor to it was originally a UK limited liability partnership, Albemarle Ship Investments LLP. We set that up at the end of 2018 and started investing in January 2019 with the 3 of us as partners and 12 others, so 15 in total, with $25 million, and started investing using the same strategy that we have today on that date. And during the second half of 2021, we then converted that LLP into its current fund structure and started taking in external capital in Q1 2022. So we've been going for about 5.5 years now, this Albemarle Shipping Fund. From those 15 original investors with about $25 million, we've now got about 85 to 90 investors and about $215 million under management. Maybe I could tell you a little bit about what the fund does. Or
That'd be great. I mean, I know you're in your 6th year now
Yep.
on your own, and you guys have done exceptionally well. You'll be great, actually, because I think people have a lot of preconceived notions of what shipping is. And I know I do. I think of just originally just giant container ships going across the ocean. And maybe you could break down the sectors a little bit that you look at.
Yeah, sure. So, I mean, shipping is a truly global business. We're looking at commercial shipping, the transportation of goods by sea. There's about 12 billion tons, 12.5 billion tons of goods transported every year by sea. That's about 85 to 90% of global trade, carried on about 70,000 vessels. About 15 to 20% of those by carrying capacity are carrying containers, cars, kind of finished goods. The other 85% are carrying commodities. So dry bulk, which are things like iron ore, coal, grains, timber. Then we have tankers, oil tankers carrying crude oil, oil products, so diesel, gasoline, jet fuel, fuel oil. And then more specialized vessels, further chemical tankers, liquefied natural gas, liquefied petroleum gas. All of these are highly specialized vessels carrying just these few cargoes. Maybe 50, 60, 70 years ago, ships were far more general. They'd be carrying lots of different cargoes at once in smaller volumes. Over there, really from the kind of 60s, 70s onwards, they've become far more specialized to carry these specific goods. Shipyards, 90 to 95% of shipyard capacity is in the Far East. These are really the suppliers of new tonnage to this shipping system. And although certain shipyards specialize in certain sectors, they are all really supplying that new growth of tonnage to all of these individual subsectors. But each of those subsectors has very different supply and demand dynamics and start from different points of utilization. And what we're trying to do is focus on those demand drivers as well as the capacity and forward availability of shipyard capacity to model out utilization, expectations, freight rates, asset values for this shipping space.
Yeah, but it's so interesting about the shipping space. I think that I didn't know about until recently, until you told me. I mean, the history of it, and then how diverse it is in terms of where it's located, right? In Asia, where they build many ships, Norway, where they have 800 years or so of shipping, and they're still down. They're still very important. Greece as well. I mean, the geopolitics of your business is extraordinary, and it's not all centered in one place. Unlike many other industries, you could argue the tech sector in the United States, energy in the U.S., and a few countries, but shipping is global.
Shipping is global in where the ships are owned and the areas in which they operate. But like I said, about 95% of ships or commercial shipping are built in the Far East. But then, they are transporting goods all over the world. Some subsectors of shipping will be far more exposed to certain locations. For example, iron ore trade into China is very dominant within that space, whereas the US features far more highly on the import of containerized goods from the Far East. Now, the US has become a major exporter of crude oil, oil products, LNG, LPG. Really, that whole shale boom over the last decade has completely changed the global transportation of liquid and gaseous hydrocarbons. And certainly the geopolitics do create problems or opportunities, depending on which way you look at it. So I guess in 2017-18, we started to have some tariffs from the US on imported goods from China. We've now having at the moment the EU looking at tariffs on the import of electric vehicles from China. Of course, we've had Russia invading Ukraine in Q1 22, which has completely changed the transportation of crude oil and oil products out of Russia, and also LNG, liquefied natural gas. And now the latest kind of exogenous shock of a geopolitical nature is the Houthi attacks in the Red Sea, which has effectively closed the Red Sea and Suez Canal. All of these shocks or changes in tariffs, political nature, they all impact shipping in different ways. Lots of these exogenous shocks, like Russia invading Ukraine, they really create inefficiencies in the system. And any efficiency really just increases utilization, and with that, freight rates. And so shipping often fares well during these periods of conflict, just because ships have to divert. There is still demand for the cargoes, but they're traveling a less efficient, greater distance. So it's our job to try and ascertain exactly how these shocks will impact shipping in the future. Or basically we have periods like this every year, some much larger, like this Ukrainian invasion or the situation in the Red Sea. These are creating quite large changes in utilization for some of the subsectors, some less impactful, but we really have to try to gauge quite swiftly what these features will be in these subsectors of shipping that we're looking at in the months ahead.
I'd imagine every year there's something, right? There's always geopolitical conflicts. So, but
there is, but also it might be something. 1 year it could be there's a particularly bad weather patterns. We've just seen the strongest typhoon in Shanghai for I think the last 70 or 80 years. Or in early 2019, we had very heavy rain in Brazil, which caused a tailings dam to collapse and reduce the export of iron ore from Brazil. So there's always something happening which will change the direction of the ship.
I mean, it's one of the cool things about your sector. I mean, I probably can't say exactly how well you've done, but you've done north of 30% annualized, and while the MSCI World's done 14. And what I've been impressed with your returns is that how well you did in 22, which was a very big down year for the equity market. You guys had a very strong year. But one thing I want to shift to a little bit is your basic thesis about shipbuilding and how that's changed. And you put it in every one of your letters, but maybe you could walk us through that, and then how it leads to big opportunities that you see today.
Yeah, sure. So, shipping by nature is a cyclical business. Historically, on average, a shipping cycle has lasted 5 to 7 years, but a longer cycle around that is the shipyard cycle. Now, these can last 20 to 30 years. That is the building out of capacity to build more ships. The last bottom in the shipyard cycle we had was in 2001, when we had about 22 million compensated gross tons of building capacity. That is a compensated gross ton. That's trying to take into account not only the carrying capacity of the ship, but the complexity of it. So that the kind of the time and cost to build it. So more relevant for shipyard capacity. Then China entered the WTO. Demand for shipping, especially into China, and the whole commodity cycle grew much faster than expected. We needed far more ships than needed previously. Shipyard capacity tripled to 65 million compensated gross tons per annum in about 2010 or 11. And from then, 2010 to 2020, we then had a terrible period in shipping. We had this huge order book of ships that had built up, delivered over the following years from 2010 onwards, which the fleet really kind of struggled to absorb. We still had healthy demand growth, just far too much supply. once we passed about 2015, 16, we then started to get a quick reduction in shipyard capacity because they'd been loss-making for many years. And since about that time, that capacity has declined about 40% to now 40 million compensated gross tons. So we've got to the stage where, by our estimates, there isn't enough capacity to build the ships required to meet normal demand and replacement requirements. That is, that ships normally last 20 to 30 years. At the end of that, they're removed from the fleet, they're scrapped, so they need to be replaced. We need about 42 to 45 million compensated gross tons per annum to meet this target, and we've got 40. So with that, we're basically, supply growth is constrained for the years ahead. What has always killed shipping cycles in the past, once rates start to pick up, once the market looks good, owners rush to the yards and order more ships. And then in 2 or 3 years' time, those deliver and kill the market and utilization declines. Then older ships get scrapped, demand catches up, utilization bottoms, and then things recover again. This time, it's not different. It's just that we're at the bottom and moving up this shipyard cycle. We can't overorder ships at the moment. What we are seeing, though, is that the shipyards that were heavily loss-making, cost to build ships has inflated with labor costs, with commodity prices, etc., over the last 5 or 6 years. Prices have caught up, so now yards are getting close to profitability. With that going forwards, we would expect at some point there to be new shipyard capacity built, but we're not really seeing any meaningful capacity coming online yet. So this really stretches out this upcycle longer than normal because we can't overbuild it fast enough.
So what do you think? Sorry, keep going. Will.
I was just going to say, and looking back on this over a much longer time frame, we've come to the end of a very long trend of shipyards moving from the West, really from during the Second World War. The US was the largest builder of new ships. After that time, from the 50s, really from the 60s onwards, shipyard capacity moved to first Japan, then to Korea, then to China, searching cheaper labor, new facilities, better productivity, new equipment, which basically meant that we've had very little inflation in the price of new ships for 70 or 80 years. That now seems to have come to an end, and there's some catch up basically on historical inflation.
It is. Am I correct that I think last stat I saw is that China accounts for 50% of all large shipbuilding at this point? Is that accurate?
Yeah, that's about the right ballpark. Yeah.
Yeah, I mean, and as geopolitical tensions heat up with the U.S., I'm sure that's got to be a huge potential issue that will be addressed just from a geopolitical standpoint, let alone just
it could be, but the US hasn't really been a shipbuilder. Much of Western Europe hasn't been. They stopped really in the 70s and 80s. The UK before that was the world's largest shipbuilder 120 or so years ago. We stopped doing this heavy industry because labor became more expensive, and it was far cheaper as the globe globalized. If that makes sense. We moved a lot of this lower tech heavy industry with greater labor content to places of cheaper labor. I'm not sure we're going to see new shipyards springing up in the US or in Europe. At least it doesn't make financial sense currently. We could see some emerging perhaps in India. We have some capacity in places like Vietnam and the Philippines. Perhaps they could be expanded on. But I'm not sure if we'll start seeing large shipyards being built back on the around Glasgow or somewhere.
Mm. Well, what do you think? What does this lead you to though today? Like, where do you think there are big opportunities? Because in addition to this extension of the cycle, as you say, you're also seeing massive changes in shipping patterns. I mean, I know from learning from you that basically this one-way trade of giant containers coming from China is now changing. I know energy is changing. The U.S. is becoming a massive exporter. So maybe you could walk through where you see opportunities today in the shipping sector.
Yeah, certainly with this shipyard constraint, we have a lovely tailwind in the shipping space in that we're not expecting a huge influx of new vessels for the fleet in general. It's different for each of these subsectors. 5 or so years ago, when we started this particular fund, it was true really across the board that nearly all subsectors in shipping had very low order books. I think the order book at that time was about 9 or 10% of the fleet, and it was about the same for most subsectors. Now, the order book as a percentage of the fleet is about 13% to deliver over the coming 3 to 4 years. But within tankers and dry bulk, so carrying these large commodities, we're closer to about 9%. And in large commodity carriers, we have Cape-sized dry bulk vessels. These are 180 to 210,000 deadweight ton vessels. The order book is about 5.5%, 6%. Similar for VLCCs. These are vessels that carry 2 million barrels of crude oil. Whereas if we look at the container fleet, because of the very strong market we had around and after COVID, a lot of the profits there have been put into renewing the fleet to meet future emissions regulations. The order book there spiked at about 28%. It's now back down to 21% as a lot of that has started to deliver. LNG, there's an order book of over 50%. Car carriers, about 40%. So it's not true of every subsector that we have very limited supply growth. So we have to factor this fleet growth into our estimates of forward demand growth for these different subsectors. On one side, we have something like the tanker market. As you mentioned, the US has become a big exporter there of crude oil, really in the last 5, 6 years, once that export ban had ended. That is completely, well, and LNG as well. The US is now the world's largest LNG exporter. But LNG as a part of the global fleet is a lot smaller versus something like crude oil tankers in terms of carrying capacity. But as that has become a front haul trade, it has completely changed the trade pattern of oil, going very long haul to the Far East. This instead of going from the Middle East to Japan or China, we're talking 2.5, 3 times the distance. And really, the demand for shipping is not only the volume of goods carried, but the time spent doing so. So the distance, the time spent loading and discharging, time spent going through ports, any congestion, the speed that those ships go at, which will depend on not only the price of fuel, but emissions levels. So yeah, that has completely changed the trade pattern for oil. Similarly, as you mentioned, for LNG, as a lot of this new capacity coming on stream in the next 4 or 5 years will likely travel very long haul to the Far East, which is why we have a 50% order book there to meet this huge growing demand. But what we do is look at the expected utilization forecasts we have for these subsectors, what we expect to happen to freight rates and asset values, and then compare that to where listed equities are priced currently. Some do not at all reflect our forward estimates. Certainly over the last couple of months, we've had tanker stocks coming back over the summer. There's a normal seasonal weakness as the Middle East exports less oil because they use more domestically. And then we have a refinery turnaround period happening now in the next month. We now move into a seasonal pattern where exports start to increase again as the northern hemisphere cools down, which normally sees an increase in tanker demand during the second half of the year of some in the range of 5 to 10% in a few months. So we during the recent sell-off in the markets, we've been using that time to increase our net length and start buying back into a handful of crude tanker stocks. We've also been, what else have we been doing over the last few weeks? We've been shifting some of our freight forward exposure. So as well as investing in listed equities, we're also looking at forward freight rates, especially for the dry bulk space and tankers. And those are forward starting swap contracts that we can trade. We've been, over the last few months, acquiring deferred kind of 2025 and 26 contracts on Cape vessels. After a kind of a resurgence in Q1 25, we've been taking some profit there. It's quite specific on seasonal timeframes as well to trade these contracts.
Right. I know you look at the different subsectors like tankers, dry bulk, containers, car carriers, and even ocean liners, right? I mean, pleasure, giant cruise ships. And it just seems like a lot of these sectors are pretty tight to begin with. And then you can either go long, longer or maybe even short sometimes, right? You do go short some of these subsectors at times. Yeah,
definitely. So the fund is, as you mentioned at the beginning, it's long short, mainly equities, about 80 to 90% of our gross exposure in listed equities. The other 10 to 20% in these freight forward contracts that I mentioned, and also other commodity derivatives related to shipping. Our stance is very directional. So between minus 50% net short and plus 100% net long. So as well as trying to correctly position ourselves in these subsectors versus each other, we're trying to pick up on the overall kind of beta of shipping as well, given this tailwind created by lack of shipyard capacity. We've been predominantly between 50 and 90% net long over the last couple of years. It's also relatively concentrated with 20 to 30 positions. Currently we're about 80% net long. We're about 120% gross. We've got 28 positions, 23 longs and 5 shorts. And the 5 shorts that we have are really dotted about in there's a couple of container names that we've been adding to. We have a trading short, as in what I consider a shorter term position where we're holding for kind of 3 to 6 months on LPG name. This is the main trade there is exporting propane and some butane from the US Gulf and the Middle East to the Far East and Europe. We've had quite a build-up of vessels delivered last year, which is now depressing utilization within that space and pulling freight rates down, contrary to kind of more general expectations in the market. So we've taken the opportunity to put on a trading short there, which has worked nicely over the last few months. So as well as having these 20 to 30 positions, we're actively managing this, but it's not high frequency trading. We're turning the fund over between 1 and 2 times a year, really. And the average hold period of our current holdings is about 15 months.
And we're, there's just not a lot of stocks out there, right? I mean, I know a few names like Frontline and a few in the US who trade here, but where predominantly do these stocks trade? And it doesn't seem like there's a ton of market cap in the space.
No. So there's about 140 pure play listed names around the world. They got a market cap of about $450 to $500 billion. So it's a pretty small niche in reality, given that these carry, nearly all global goods, 85, 90% carried by sea, and it's only $500 billion market cap.
They're worth half of one tech company in the US, one of the megas.
Well, exactly. So yeah, because of this, and it is quite complex in that there are so many different subsectors, and within each of these different subsectors of things like crude tankers, there are then different size categories which have very different trade patterns. There are very specialized elements like chemical carriers. As you mentioned, the container space, that's got a very different setup to the rest of the commodity space in that they operate more a liner service, so more like a bus route versus a taxi service for the commodity space. I mean, there's a lot of inputs, a lot of data we're getting every day. Really, we're receiving updates on freight rates, on asset values, on trade flows. There's a lot of work to put together to create this holistic view of the space. And after all of that work, there's quite a small space to invest in. I mean, because of that, it's a pretty undercovered niche. When I was first doing this back in 2005, 6, 7, we had this very strong upcycle. During that period, quite a few private companies started to get listed in the US. That could happen because listed companies were priced at a premium to private ones. They were priced at a premium to the secondhand value of their assets. Because of that, it made sense to list a private company close or above this NAV, well below where the public companies were traded, and investment banks could do a lot of business there. Since 2010, we've really been at times quite significant discounts, listed companies to private ones and asset values. Because of that, many investment banks have dropped their coverage of the space because there's very little capital markets business to do. And I mean, that will start to change going forwards. We still have some coverage in places like Norway, where shipping is still a decent part of their national equity index. But in the US, it's a tiny it's a tiny niche segment.
So is most of your book, is it listed in the US or is it listed in Europe or Asia?
The universe is fairly evenly distributed across the US, Europe, the Far East. What is listed in those locations are slightly different. In the Far East, this is where all of the shipyards, those that are listed, are within places like Hong Kong, Taiwan, Japan. Also, they're far heavier weighting towards the container space and dry bulk companies. Whereas in the US is a bit more mixed, and the container liners, they have one container line listed. The container exposure they have is more focused on tonnage providers, so those companies that will own ships and lease them to the operator. And then we've tended to have in Europe and the US a lot more focus on oil products, chemicals, so more hydrocarbon related shipping companies. But it's pretty evenly distributed around the world.
And Will, one thing I forgot to ask, but I want to just go back on is that, not because you said there's a structural issue in your space. I mean, you wrote recently that these stocks are at a 25-year low, and yet they've rallied a fair bit the last 4 or 5 years. How do you measure that? Is it just because your forward earnings are so much higher than what sell side exists?
This is really so looking at the enterprise value of these listed companies versus the underlying value of their assets, but adjusting that historically for the inflation at shipyards. Now, as I said, there's been very little inflation on average over time, but it kind of waxes and wanes over these small cycles. Over the last, really since 2017, we've had quite strong inflation in shipyard costs. And when we adjust what these companies are priced at versus the real replacement cost of adding new tonnage to meet new demand and the replacement of older ships, then we've barely moved in valuation terms since 2017, 18. Certainly share prices have moved up, asset values have moved up, but they're still, shipyards are only just becoming profitable now. We've really just been catching up with inflation.
I think that's what we call in the hedge fund business an opportunity.
An opportunity. I guess the One thing I haven't mentioned as well is talking about this shipyard constraint and supply constraint going forwards. Another big issue, well, for the world, but also for shipping, is the environmental outlook. Shipping is governed largely by the International Maritime Organization, which is part of the UN. And from 2011, they started to implement emissions regulations, first on new build vessel designs, which had to meet certain requirements, which tightened every 5 years. And now from the beginning of 2023, we start to have a carbon intensity index, which is measured every year. Ships need to conform to a certain level. They're graded A, B, C, D, E. If they're not A, B, or C, they need to implement measures to reach those levels, which could either be operational in that they can slow steam, use less fuel. For the older ships, they've probably already done that. They can't anymore. They could retrofit various kind of energy saving devices, but these are marginal in their impact. What this means is that the scrapping question, which normally you would have had for vessels when they reached their kind of end of life between 20 to 30 years, when they went for a special survey. So every 2.5 to 5 years, you have to take the ship to be checked out, and you have to replace steel, and maybe there's some mechanical and electrical elements that need to be replaced. You're now going to have to do that every year to meet these emissions regulations. So older, less efficient ships, but we're talking, instead of being 20 to 30 years old, these could be 15 years old. They're going to start being removed from the fleet more swiftly from 2026 onwards. So we don't have enough shipyard capacity anyway. We're now going to have this environmental emissions regulation replacement cycle coming as well. So it really tightens this whole equation. But it also means that for those companies that have modern, efficient vessels on the water already, they're going to be the real winners as this replacement cycle comes, and it becomes more and more costly to replace these ships at fewer shipyards with less capacity.
And who would be an example of a winner in your view over the next couple of years in light of what you just said?
Well, I mean, a number of companies that we hold on the long side. Certainly over the last few years, we've been enjoying this supply equation on the car carrier side. Now, this is a very small niche. These are vessels that specialize in literally driving cars and larger vehicles, buses, trucks, etc., onto decks within the ships, carrying them across the ocean and then unloading them at the other end. This was a segment which had struggled really from 2012 to 2020. Fleet had aged a lot. They'd scrapped many ships. Demand had been growing close to zero. The fleet was reducing to meet that weak demand. What we've had in the last few years is a huge increase in exports from the Far East of especially electric vehicles to Europe and elsewhere, and a fleet that was still shrinking. And these vessels are built at only a handful of yards. It's quite specialized type of ship. They have a different type of steel, a high tensile steel used rather than a kind of a heavy plate, which is much harder to weld. Because of that, whilst demand has been growing 8 to 10% per annum, the fleet has barely shifted. That starts to change from the end of this year going forwards, but we're at a theoretical utilization level for this car carrier fleet of over 100%, more like 110% at the moment. The company we've been investing in to exploit that utilization mismatch is one that listed in Norway at the end of 2021, Höegh Autoliners, listed at 21 kroner a share. It's now about 140, but that's after it's paid out some considerable dividends as well. So it's probably up 7 or 8 times over that period, basically as this freight rates within this space, once utilization starts to move into the kind of 90% range, freight rates move up asymptotically. This company's now been fixing its capacity on 3 to 5 year contracts out in time at these record high rates. It's been selling much older ships at record high prices, as well as now taking on 12 new build ships, which have started to deliver now, which are much larger, more efficient. They will be, I mean, they're ammonia ready in the sense that once a new propulsion technology is designed, they can burn cleaner fuels. But this company is priced at 3 times EV/EBITDA and has contracts of 4 to 5 years in duration. It's paying out 100% of its earnings and profits, cash profits from selling these older ships. So we expect by the end of 2025 to have received about 45% of the current share price back in dividends. And the majority of that exposure of their operating exposure is covered. So it's a stock that's done very well over the last few years, but still looks very positive. On the other side, I mean, I was going to give some more, but yeah, I think that kind of nicely sums up the kind of thinking that we're doing to try to model forwards these supply-demand mismatches versus what we can see in the markets. And of course, when things move in shipping, not only do utilization improves, freight rates start to pick up, so the company starts to earn money, but at the same time, the value of their assets start to increase as well. There's quite a healthy secondhand market for most types of generic ships. So not only do you actually start to earn significant amounts of cash, but the value of your balance sheet increases dramatically as well. So you have these kind of multiple layers of leverage years out in time, which is why these equities can move 2 to 5 times in a couple of years if you pick those right moments.
Right, and being uncovered, and there are just so many factors that go into this too, right? I'm sure when I hear car carriers and electric vehicles coming out of China, I think of what the U.S. election, and massive tariffs, and EU is doing the same thing. And I'm sure you're thinking about that all the time. I know you count things. You're very good. I remember you're a math major, and but some of these softer events that are obviously very meaningful have a huge effect. But I guess having contracts over 3 to 5 years really protects these guys.
Exactly, but also it's important to delve into the details. So the US doesn't really import any electric vehicles from China. So it's politically, and it's an easy win to slap a 100% tariff on them because it doesn't really impact anything, but it looks good.
It's one of the things too that there are just so many interesting factors. I didn't really want to go down the fuel thing, but I remember seeing ships starting in a port, and bunker fuel is probably the worst thing in the world, I would imagine, for the environment. And now this change, and then just reading The Economist about huge tankers experimenting with sails again after a few hundred years. It's quite, I know, and ammonia, right, as a fuel. So it's quite
it's a burgeoning space for the fact that these IMO regulations, International Maritime Organization regulations, dictates that the carbon intensity of shipping needs to decline by 40% by 2030 and to be carbon neutral by 2050. Now, currently, shipping carries 90-ish% of global goods by volume. It produces something in the range of 2 to 2.5% of global greenhouse gas emissions. So it's doing this because it's so ubiquitous and carrying such large volumes. It is by far the cleanest method of transportation because you're not competing with gravity or friction. If you look at something like I think roads about 10 times more emitting per ton mile. Air is 60 to 70 times more emitting. So shipping is good, but it's going to get a lot cleaner. But to get there, we need to, and there's been a lot of work there over the last, 5, 10, 15 years on things like retractable sails, on Flettner rotors, on kites, directional kites that can act like a sail, on new propulsion technologies like green ammonia, green methanol, bio LNG. The engineering work, testing work is being done for a green methanol engine. LNG engines already exist. Ammonia is in development and might appear on some vessels from 2026 or 27. The idea being that you're using a cleaner form of hydrogen without expelling the same amount of carbon. What we don't have really are the volume of green fuels required to drive these vessels under new systems. So we don't really have large or meaningful volumes at all of green methanol or green ammonia or bio LNG. But these things work in tandem together, and we will likely get there. But with that, there will be new cargoes to carry. If the world fleet isn't using fuel oil, then fuel oil won't really be used in much anymore, because it's largely purely used in shipping, and a few oil-fired power stations still, but that's dwindled away mostly. Instead, ships will start to carry more ammonia and more green methanol and more bio LNG, because it will, these will be the liquid transportation fuels that fill in the gaps where, electricity and batteries can't yet work.
And Will, I can't think of a sector now. Actually, we touched on energy, but I just want to go through a little bit, because I can't think of one of the sectors that's changed more in the last decade. And now that Nord Stream got blown up by somebody, I think what we now know is that pipelines can be blown up, undersea. And so, and now that the U.S. is exporting so much and set to, I know what you said earlier about LNG capacity being quite smaller, and I understand, but I think it's a huge area of focus for U.S. infrastructure the next 2 years, that how much LNG capacity is ramping up and who we're going to export to. I mean, how has that changed what you do and how you look at these different stocks? Because it used to be a one-way road out of Saudi Arabia, right, going to the rest of the world, or the Gulf, and now that's dramatically changed.
On the LNG side, when kind of before, I guess things changed in about 2011, but before that, really LNG ships were floating pipelines. Effectively, a large facility would be built, often as part of a new gas discovery. The gas would be processed, then it would be liquefied, and then it would be shipped from that one location to another predetermined location on a very long-term contract, 15, 20, 25 years, especially to Japan. And one wasn't really allowed to deviate from where the gas could be sold. 2011, you had the Fukushima, the tsunami, which damaged the Fukushima nuclear power plant. A lot of nuclear capacity in Japan was closed down. Because of that, they had to suddenly import a lot more LNG, and some of those destination requirements were dropped. And that met at the same time the beginning of the build out of some US liquefaction capacity, much of which originally had been to import LNG. It got turned around effectively to export LNG. And much of those volumes coming out of the US Gulf were instead sold into portfolios which didn't have destination clauses. They could effectively be traded around the world. And so for the last 10 or so years, the LNG market has begun to look quite different. You still have these long-term contracts with destination clauses, but a lot more. You have large traders, energy majors, basically picking up cargoes and working them in their portfolio to their advantage to sell in the best location, far more like the oil market. So the benefit of that we saw in 2022, when Europe couldn't import gas via pipeline from Russia. it instead could import dramatically more LNG from this new source in the US Gulf. And that is set to increase dramatically over the next 4 or 5 years as the US builds out yet more liquefaction capacity and becomes by far the major exporter to the world. We've got large volumes coming in Qatar as well, what used to be the world's largest exporter before Australia took that over in about 2015 or 16 from memory. And then the US, about in the last year or two, has become the largest exporter. So, I mean, really, the US, having been a huge importer of energy, has in the last 10 to 15 years become the world's largest producer and exporter of hydrocarbons. All of that has changed the landscape completely.
It has, and one of the things I want to wrap up with actually is this history of shipping in these countries, because I know this is maybe the liberal arts person in me, but like that, the fact that Norway is still dominant after thousands of years. Greece, I mean, you guys have Norwegian roots. I have one of the best hedge funds I know in the space also is that in Athens, Greece. And even the Far East. I mean, where you're seeing people have been dominant in this area for 1,000 years are still dominant. And I just wondered how much national identity and sort of history goes into just your view on that, and if that will perpetuate, or will we see a lot of new countries and new players?
Yeah, I think that's hard to say. Certainly, Greece remains one of the largest owners and investors in the shipping space. We've seen China increase a lot in the last 20 or so years as they've entered the World Trade Organization. Like you say, Norway has remained, I guess, because so much coastline and coming back from their roots as mariners, but also fishermen. Similarly, in Greece, probably because of their geography, the fact that so many islands in the edge of the Mediterranean. A lot of this would have been trading by sea thousands of years ago. Similarly, the UK was a huge maritime nation. Much of that has faded now. I'm sure these identities will continue. Certainly, what has some countries have managed very well are supportive environments, either from a trading or taxation point of view, in places like Greece, Norway, Singapore, to attract not only shipping companies, but the services around them. So traders, brokers, law, bankers, legal, there's insurance. There's a huge plethora of services that sit behind this asset intensive industry.
And then in the US, we have a pretty protected market, not just because we don't have many people around us with two big oceans, but the Jones Act, right? I mean, I guess listeners can look up what the Jones Act is, but it is very protective of our shipping industry.
It is, and I think it makes sense for nations to have the ability to build vessels and a fleet of a certain size, just in case of suddenly you have no friends, or you can't import from certain places, or there's a military situation, and that Jones Act system was put in place partly for that reason. So ships have to be built in the US, crewed by US people, owned majority by US individuals. Because of that, it is a much older, less efficient fleet than the global fleet, because it's very costly to replace these vessels in the US. It costs 5 or 6 times as much to build a ship in the US as a similar ship in somewhere like Japan. But we in the UK don't really have much shipyard capacity anymore. We don't really have a fleet of any meaningful size. It's perhaps elements like this which they should be considered kind of structurally important industries like steel and and shipbuilding, etc., which at some point may be called upon. So the US, it may seem like a kind of a protective factor, but it has some political sense.
Well, I guess you're carrying the torch for UK shipping as a speculator and you're doing exceptionally well. Well, this is fantastic. I think it's such a cool sector. We're going to be investors in it soon. So I really appreciate your time today, Will, and wish you much success.
Well, thank you very much. It's been fun to talk. I apologize for my rambling, but hopefully there's been some useful points come out of it.
It's useful rambling. Thanks very much. I appreciate it.
Thank you for supporting the Thematic Investors Podcast, presented in partnership with Vidrio Financial. Vidrio's data management solution collects, scrubs, and allows investment teams to filter out the data noise, providing you with actionable data intelligence for further visualization around valuation, risk, and portfolio management. If you are an endowment, foundation, pension, sovereign wealth fund, asset manager, OCIO, or family office struggling with your data pipelines, then reach out today and see how Vidrio's data management solution can help by becoming an extension of your investment team. The information covered and posted represents the views and opinions of the guests and does not necessarily represent the views or opinions of Vidrio Financial and/or our host, Kieran Cavanna. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding investment planning.